If you are thinking of retiring soon or already retired, this is a must-see presentation. Today, we are going to rethink everything you thought you knew about retirement. Meet Bob and Susie Smith. The Smiths are both 62 and would like to retire when they are 65, and they have a $1 million portfolio. Using the 4% rule of thumb with a traditional 60-40 portfolio, the Smiths could expect $40,000 of retirement income per year. Of course, this will be non-guaranteed and assuming no growth between now and the time they retired. And just so you know, a 60-40 portfolio is a common rule of thumb for retirees, which states 60% of their portfolio will be in stocks and the remaining 40% in bonds. This is not making a judgment on whether this is right or wrong, only pointing out what a typical retiree's portfolio might look like. If suitable, what if we invested the 40% of their portfolio that was in bonds in a guaranteed income product instead? Typically, this will be an annuity. However, an investor's unique financial situation and other factors we'll address in a minute will dictate which type of product will have the highest amount of guaranteed income. Okay, so let's substitute the 40% of their portfolio that was in bonds in this hypothetical scenario with an annuity. The simplest type of annuity to illustrate and understand is the immediate annuity. This is simply where you give an insurance company a lump sum of money, and in return, they give you a guaranteed paycheck for life. If you start your income stream more than 1 year out in the future, then what you're looking for is known as a deferred immediate annuity, or DIA. Now, one hang-up people have about immediate annuities are, what happens to my money if I die? Without getting into all the nuances of every option available, I want to focus on the most common contract written today, which is life with cash refund. In this case, if the Smiths were to invest $400,000 into a cash refund annuity, and let's say get hit by a bus the next day, then their heirs would inherit the entire $400,000. Now, if the Smiths were to hypothetically withdraw, let's say $100,000 and then get hit by a bus, then their heirs would inherit the $300,000 difference. Now, I want to make one point very clear. By no means are we saying this is the best type of annuity out there or this product is suitable for everyone. The type of annuity most suitable for the investor will depend on the investor's liquidity needs, legacy concerns, risk tolerance, differences in ages between the significant others, amongst many other important considerations. The bottom line is, get a hold of myself or my team and we can put your information through our proprietary calculators and help you determine what the most suitable type of annuity for you and your family is. Now, ideally, this would be done after a financial plan, but for the interest of this presentation, we won't get into that commercial now. Okay, so where did we come up with the $23,712? In order to figure out this number, the first thing we did was go to immediateannuities.com. Please note, we have no affiliation with this website whatsoever. Immediateannuities.com is a great place to get an approximate amount of income of how much you could expect from annuity. Again, immediate annuities are the easiest type of annuity to understand, and usually their payouts will be close to what you could expect from other classes of annuities, and this will also make it so you can play along at home as well. Again, we want to focus on the life with cash refund option. Using this option, the annuity would pay out so long as either of the Smiths are alive. Using the 4% rule for the 60% of our investors' portfolio that was in stocks, 4% of $600,000 would give you $24,000 of income. So if we take the 60% of their portfolio in stocks, that would give us a non-guaranteed $24,000 per year, and combine it with the 40% of their portfolio that would now be allocated to a joint annuity, which would give them $23,712 of guaranteed income for life, the Smiths could now expect $47,712 in hypothetical retirement income underneath this scenario. Now, another way of looking at things, if Bob and Susie still wanted to strive for $40,000 a year in income, now they would only need to pull $16,288 from the 60% of their portfolio that was in stocks, or 2.71%. This would put a lot less stress on their portfolio and greatly decrease their withdrawal rate risk. Now, going back to the classic 60-40 portfolio, using the US government 10-year bond yield of 2.16% as of June 21st, 2017. If the Smiths had the 40% of their portfolio that was in bonds in a 10-year U.S. Treasury bond, they would have $426,484 by the time they were 65, which would give them $9,212 of retirement income per year. Now, assuming no interest rate risk and prevailing rates stayed the same at 2.16%. And also have to stress, this is a hypothetical example and is not representative of any specific situations, and your results will more than likely vary. In order for Bob and Susie Smith to generate the same $23,712 the DIA, or Deferred Immediate Income Annuity, would provide, the $400,000 that was in bonds would have to turn into $1,097,777 to yield the same $24,684 at a 2.16% interest rate. Expressed another way, the Smiths would have to grow their money at a compounded return of 40% for 3 years straight to turn their $400,000 into $1,097,777. Using Morningstar's safe withdrawal rate of 2.7%, a $1 million portfolio would generate $27,000 of income. If we assume a 60-40 portfolio using 2.7% for the stock portion of their portfolio, that would give us $16,200 a year in income. Now, if we combine that with the aforementioned DIA income of $23,712, if we add those two amounts together, we get $39,912 of income, which is just under 50% more income than the Morningstar number. Okay, so let's recap. Using Morningstar's safe withdrawal rate of 2.7%, $1 million would generate $27,000 of income. Using the 4% rule of thumb, the Smiths could generate $40,000 of income. And using the alternative 60-40 approach discussed today with a 4% withdrawal in equities, the Smiths could plan on $47,712 of income, of which $23,712 would be guaranteed for life. While no strategy is foolproof, we believe all investors should have the amount of income they need in retirement covered by a combination of Social Security, pensions, and annuities. If an investor needs $50,000 to live on but only receives $35,000 from a combination of their Social Security and a pension, we would aim to find the appropriate guaranteed income product with a goal of managing the $15,000 shortfall. The rest of their funds could then be appropriately allocated using low-cost index or mutual funds. Now, many variants will determine the optimal guaranteed income product for any given client, including but not limited to how many years they can defer, age of client and their spouse, health of the client and their spouse, legacy concerns, how much they live above or below their means, need for principal protection, and their risk tolerance, just to name a few. Now, after we cover your shortfall with the product that will give you the most amount of income given your unique situation, we will then stress test your portfolio using Monte Carlo analysis. The goal is to have an 80% success rate or higher, or expressed another way, having less than a 20% chance of having to make a change along the way. Now, to help guard against sequence of return risk, we will then layer in a worst case bear market scenario using your portfolio's risk-alized results. If your financial crisis hypothetical scenario showed a decrease of, let's say, 33.9%, we would then simulate your portfolio decreasing by 34% at the worst possible time of your retirement, which for most people will be the year they retire. If your Monte Carlo bear market simulation comes back north of 80%, we know that we are on the right track. If not, we either need to lower the risk in your portfolio or increase the amount of guarantees in your retirement, assuming you aren't willing to lower your standard of living. We want you to feel confident knowing that we have strived to help preserve your retirement. If you are concerned about running out of money and would like our help, please give the Certified Financial Planner Professionals at the Liberty Advisor a call today, where your future is our focus.